discussing double entry concept. Double entry concept. The double entry concept states that for every debit entry made in the books of accounts, calls for corresponding credit entry. Corresponding credit entry. Now, that comes to ledger. Ledger is a book of accounts where any transactions of the business is recorded. It resemble letter T, and that is, we'll have that as a ledger. It has to have a title. This side is called the debit side. This side is called the credit side. So debit side records on debit transactions. And credit side, credit records all credit transactions. That's the introduction. The double entry is a concept that detects that for every debit transaction, call for a corresponding credit transaction, and that transactions we put them in the ledger, where a ledger is a book of accounts where any transaction of the business is recorded. So types of ledger accounts. Number one, we have personal accounts. Which records transactions relating to one business, firm, two personal accounts. For example, so double entry rule for this, debit receiving accounts, credit giving accounts. For example, Kamal bought goods on credit, from Patel. Now here, Kamau is considered the owner of the business. Hence, his name should not appear in our books. Appear in the books because there is separation. There is separation between the owner, and the business. So Kenya shillings, example, we can say 100,000. So Kamau bought goods on credit from Patel, Kenya shillings 100,000. Now you want to record this in transactions. So the first thing is first step, identify the accounts to be effected. I can also add the date on 1st January 2025. Step 1, identify the account to be effected. In this regard, I will open purchase account to record purchases of goods meant for resale. And the other one, I will also bring the other account, which is Patel, because he is a creditor. He was not paid. So in this case, I'll have these two accounts. I'll have these two accounts. One will be purchase account, and one will be Patel's accounts. Purchase accounts and Patel's accounts. So among these goods, which account is receiving? But Kamau is buying goods, so the goods are coming into the organization. So this account is receiving. But when Kamau give us the goods, Patel give us goods, the stocks of Patel decreasing. So this account is giving. So you come here and write the date 2025, January 1st. What happened? There was Patel, purchase from Patel goods worth 100,000. You put them in van. Okay, sometimes if you have the time, you can do this in exam. You can do that, but most cases I would be following that because see the same thing. You come here and also say 2025, January 1st. What happened? There is purchases. How much was the amount? 100,000. So this is a Patel's account, is an example of personal account. Personal account. So that is what I mean by double entry. For every debit we made in the books of accounts, we have debited purchase accounts by 100,000 and we are crediting sales accounts by the same amount 100,000. It's not double entry if the amount of money recorded in these two accounts is different. So let's go to number 2. Number 2, let's go to personal accounts. Let's go to personal accounts. So this is further divided into A, real account, records purchases or sales of fixed assets. Fixed assets such as land and building, motor vehicle, furniture. So the double entry rule debits all asset accounts with purchase and credit all asset accounts with sales. So for example, Kamau bought a motor vehicle on credit from Kenya Motor Limited, Kenya shillings worth 600,000 on 3rd January 2025. So this all can again, you must identify, the step is identify the accounts to be effective. So in this case, I say Kamau Muniz Maso's capital account, but there is a purchase of motor vehicle. So we open motor vehicle account, you open motor vehicles account, and the other account is Kenya Motor Limited, because the transaction was conducted on credit basis. So you come and open that account and this account, motor vehicles account, and Kenya Motor Limited. So you come and see 2025 January the 3rd, what happened? Kenya Motor Limited, 600,000. You also come here and see on 2025 January the 3rd, what happened is motor vehicles account amount is 600,000. So I've said here debit all asset accounts. So this is an asset which is example of real account. And I've said you debit with purchase, we bought it and I've debited that account, but we credit the account that has given us the asset on credit. So let's go to number B on the same, which is nominal account. Nominal account. Synthetic class. Class again, please. Nominal account. This records 1. Expenses, 2. Income and gains, income, 3. Losses, 4. Gains. So double entry rule, debits all expenses account, and debit all expense account and losses, and credit all incomes accounts and gains. One take two example, one to explain gain or income and the other to explain expenses. So on 10th January 2025, Kamau paid his rent by cash, Kenya shillings 20,000. And on 15th, Kamau paid, sold goods in cash, Kenya shillings 50,000. So let's start with the first one. Account to be affected on the first one is rent, which is expenses, and the other one is cash. What is happening? We open that account like this. We say rent account, and we say cash account. So when you pay rent using cash, what is happening to the account? There is a reduction of cash, so we credit. So we say rent account is 20,000, and you come here and also say 25th January 10th. What happened? We use cash to pay rent, 20,000. So this is rent, is a nominal account, which is expenses. And I've said here, for those we debit. And the cash account, there is a reduction, so there is loss of cash to credit the cash account. So let's do the last one, which is the one they've written. So on 15th, Kamau sold good in cash, 50,000. So what account do we need to effect? Account which we are going to open is the transaction which is selling goods. So we open sales accounts. And how did we sell the goods? We sold the goods by receiving cash. So we open cash accounts and sales account. So we do this. We come and say, what is happening to the cash? We are receiving cash. So we debit the cash account 2025, January the 15th. We say sales amount is 50,000. And on this side, we say 2025, January the 15th. What happened? There was cash. How much? 50,000. So sale is an example of income and is under real account. And say under income, we credit. So that gives us the illustration. So maybe next lesson we will do a comprehensive example and see how we can do the double entry, closing the account and extracting a trial balance.